Hi everyone, I'm Ken from CryptoTradingKS and the inventor of the CTKS method. Today we're going to look at several powerful timing signals that can help you better trade and invest. If you would like insights not found anywhere else on YouTube, please like and subscribe. We do deeper knowledge dives inside the CTKS Masterclass. Links are in the description of this video. Let's run the numbers. The first thing we're going to look at is the CTKS Risk Indicator. This is a proprietary indicator, and it gives some amazing timing signals. Let me show you how. I've just decreased the visibility on the SP 500 and Bitcoin because I want to focus you in on what happens when the risk indicator goes up very high and then it gets cut. Let's have a look at this specific area. And I'll just pop the SP 500 back on for you. You can see that the risk indicator was cut around here. The SP 500 was wobbling around a bit, but as the risk indicator came down and down, you can say it pulled the market down with it. It gave you a powerful timing signal so that you could better trade and invest. Did it work on Bitcoin? The answer, yes it did. Bitcoin was coming down when the risk indicator was coming down too. What does the risk indicator coming down even mean? It means that risk is coming out of the financial system and all markets are interdependent and intercorrelated. What about this second peak here as risk was increasing inside the market? We can see that this is a very tight cut line. You could do a looser cut line through here, but just let's look at this one. As this particular risk indicator was cut, what happened to the S&P 500? We can also see that the S&P 500 was coming down as well. Let's look at the next cut in the risk indicator. It occurred around here as the S&P 500 was just wobbling around. It was showing a lower low. That was a bearish maneuver, and we saw the risk indicator indicating that the market could very well come down. Is it a guarantee? No, it's not. Is it a probability? Yes, it is. For example, when we see this particular area, we had a cut in the risk indicator. The market did come down, but we see it bottomed out rather quickly. So we must be wary of looking at this risk indicator each day, and I will be doing that each and every day from now. We'll look at it right up the front of each video. Of course, the main question that we need to answer right now, what is the risk indicator telling us? The risk indicator is saying to us, be a little bit concerned about the S&P 500 because risk is coming out of the market just at the moment. The last time the risk indicator was cut like this, we saw a big fall off. What happened to the S&P? It didn't fall off immediately. In fact, it came down and then retraced. You've got to be aware, all price is moving in a wave. We know that there's a lot of economic issues out there at the moment, such as the commercial real estate sector, $20 trillion worth of time bomb waiting to explode, but those explosions can take a long time. We are therefore seeing a weakening in terms of risk on sentiment, but not a collapse of risk sentiment. This is important to understand. The other thing to note is that Bitcoin's gravitational bias is very much weighted towards this risk indicator. But what happened down here? Why was there a divergence? That's because FTX imploded. Market events can make things go out of synchronization. This is also something all professional traders and investors understand. I'm going to drill in to the NASDAQ 100 futures, and this is a chart I share inside the masterclass in TM6. You'll note this is the 8 charts that I talk about pretty much each and every day, but I wanted to show you what other timing indicator you can get for the stock market. And it's also incredibly good for crypto. One thing, Bitcoin does tend to lead the main markets in terms of risk on or risk off sentiment. You can see when the NASDAQ was just consolidating up here, Bitcoin was already selling down. And you can just see from a bird's eye view, this is the FTX implosion just here, which pretty much marked out the bottom of Bitcoin's price so far. So when we look at this, you can obviously see that Bitcoin and the main market indices are very correlated together. That doesn't mean directional correlation, doesn't mean as one index moves up, the other must move up. It just means it's likely to. Unsurprisingly, we have this rule inside the masterclass, Rule 225, Bitcoin cannot escape the stock market's gravity. In fact, it's even better than that. You can see many times in Bitcoin's history that Bitcoin's directional correlation can actually predict what can happen to main markets. Bitcoin is another powerful timing signal to help you trade and invest better in the main markets. Looking at the SP 500, we need to understand what is actually happening inside market structure. What you'll typically see, a lot of influencers talk about recent indicative price or RIP, and masterclass students and CTKS method students, you know very, very well what that does. It RIPs your money. It's like going back a couple of weeks and saying, this is such an important level. Oh my God, if this level doesn't hold, it's all over. You can't think like that. The markets have been trading in some cases since 1888 in the case of gold. Recent price action, of course, it's important, but it doesn't decide the fate of an asset class. So what does decide it? What decides it is smart money buy and sell levels, and we've been looking at this for quite some time. The S&P 500 in the last trading session closed at 41.54, just below a smart money Stanfield zone sell level of 41.57 to 41.66. This is why the risk indicator is going down at the moment. It's also why Bitcoin has been very, very volatile recently. I gave you your first timing and investing indicator, which is the CTKS Risk Indicator. The second one is to understand the directional alignment of Bitcoin to the major market indices. This is the third one, the CTKS method. What does the CTKS method actually provide you with? You need to know a lot of things to do it. This is just part one. You also need part two. Part 2 certification requires so many things. You may think it's very easy to draw these lines on a chart. It is not, but your money is on those lines. For example, if you were trading the S&P 500 index and not knowing this smart money sell level was there, you would get consistently crowded out of your trade, as so many people were actually piling on to this trade when it was coming into a smart money sell level. Let's zoom in a little and show what the S&P 500 recent indicative price support is. You must use RIP, but not in the way that retail thinks about it. Here you can see a confluence. We've got this upward support level. That's looking quite good. This secondary support has been weakening. What does this actually mean? This means that the selling activity up here in this smart money sell level zone between 41.57 and 41.66 is quite strong. It's actually pushing the buyers down, but the buyers are literally trying to get up. That means we need to see seller exhaustion before the buyers can push through this level. Could they push through this level? Yes, absolutely. Could the sellers dominate? Yes, absolutely again, because what you see inside markets, money is always flowing between a smart money sell level and a smart money buy level. Smart money sell and smart money buy. This is how markets work. If you know this, you can zoom out to whatever potential time frame that you want to look at, and you can see the market structure. You must understand market structure, and the only real way to do that is to use the CTKS method. Let's look into Bitcoin in a little bit more depth. Bitcoin is currently trading at $30,211. Thank you to everybody for your very kind comments in yesterday's video. And Crypto Badger said, three-way decision making. It's a really key thing to do. You must hold three divergent opinions in your mind at the same time. Price can go up, it can go flat, or it can go down. You must think about the markets in that way. We've been taught to only have one opinion, only one view, and that causes a lot of problems, not only in trading and investing, but also society. There are literally an infinite number of paths that price may take, but we could see something like this if you have a bearish notion on what the markets may do, always keep an opportunity mindset. It's very, very important. If the markets were to get negative price momentum, we would expect that they would hit this 27,609 to 28,061 smart money support level. And this is not drawn through recent indicative price. It's drawn from all of Bitcoin's price history. Now look at this. If we get a negative air gap up here, we would expect further negative sell momentum. These are very important things to understand, and we do deep dives on negative air, positive air, and so many other inventions that I brought into the crypto and financial markets inside the masterclass. So what could be another way that Bitcoin could go? What would the bulls be looking for? And just remember that you have to stack probabilities on which one you think is more likely. We could get something that looks like this. Price coming up, coming back, retesting this smart money sell level between 29,922 and 30,551, and then coming up to the next smart money sell level. And when the sell level occurs at around the $35,000 mark, you would expect the sellers to come in and push price down. How do you know what trend you're looking at? You look for a series of higher highs or lower lows. This is the trend. And it's vitally important that you understand trends. But there's also a third way the price can move. Price can also move flat, just horizontal, and when price moves flat, it doesn't just go in a straight line as most people think. It's almost like when you look at a stable coin, you expect it to be $1. No, it's not $1. It's always going up and down, up and down. It's the same when price is flat as well. Stanfield zones and Stanfield lines, SCs and SLs, will give you an incredible perspective on the market. Right now, we're looking at gold, and gold has been trading since 1883, and all of that price history has been marked up with the CTKS method. Gold is currently $2,004, and we notice something very, very important. This smart money, once a buy level between 2014 and 2025, was cut through with abandon, and it was caught by a lower price support level. This is exactly why you do the CTKS method. The CTKS method is the only method that tells you where price can stop and reverse. Stop and reverse, stop and reverse. It's very, very vital. Moving averages can never give you that depth of information. A lot of people think that they can, but as a former lecturer in first and second year statistics, I guarantee you they cannot. Where could gold potentially go in the next 24 hours? We know it can go in one of three directions. The question is, which one becomes more probable? Let's just have a look at the flat or horizontal, the consolidation. We could see it could come down to this smart money buy level between 1998 and 2000 and just hover around it. That is the going flat proposition. If price actually goes down and cuts through the first smart money sell level at around 1999, we would anticipate a retrace. This is very important. Just because it's coming down doesn't mean it's not going to rebound up and retest that as resistance. And then we would expect it to come down towards the next smart money buy level between 1978 to 1981. Don't forget, price is always moving in a wave. What about a bullish scenario? What do we expect there? We would expect a movement up to the next smart money sell area between 2014 and 2025. If we see gold starting to get above these retail levels, and why am I saying retail? Because this is where most people look. If the people are going bearish, they'll need to cover their short positions or they'll get liquidated. That could push price up. A lot of people were long on gold and the shorts came in and absolutely decimated this level. These strong levels can be passed through. And what happens then? It will be caught by the next level underneath. What about if we just smash through this 2025 level? We would expect price to get caught around the 2033 mark. So just be aware of these things. It really comes down to the slope, the gradient, the steepness of the line. There are always intercorrelations and interconnections between every single chart that you look at. Gold is closely associated with yields. As yields spike up, gold doesn't like that very much. It tends to spike down. And don't forget, yields increase the attractiveness of the US dollar, so the DXY can come up. So when yields come up, the DXY comes up, poor old gold gets hit. We're going to keep a very close eye on the CTKS Risk Indicator going forward. I hope this video has given you several powerful timing signals that can help you better trade and invest. If you would like insights not found anywhere else on YouTube, please like and subscribe. We do deeper knowledge dives inside the CTKS Masterclass. Links are in the description of this video. Have a great day or night ahead, my friends, and we look forward to catching up with you again tomorrow. Bye for now.